Dan has been the director of the Committee for Monetary Research and Education. That's a nonprofit organization that seeks to promote greater public understanding of the nature of money. And, the organization hasn't been too active recently, but I understand in talking to Dan that it may be starting up again, and it's certainly an event, an institution that I've enjoyed in the past. Very intellectually inclined, those that care about money, which is very, very important. I think most people care about money, but they don't care to understand very much about it, and that's what we want to talk to Dan a little bit about today and help us understand money. Dan also is the founder and managing director of Mannarino Capital. I always have trouble saying that. Mannarino Capital. And he was previously a partner at Bearing Capital LLC. That's an asset management firm specializing in Latin American energy, commodity, and infrastructure projects. But mostly, I really appreciate Dan's writings. He writes quite a bit, probably not as much as he'd like to, but a lot of really interesting things having to do with money and gold and investments that most of the people in this show, that listen to this show at least, are interested in. So thanks for joining me again, Dan.
Thanks for having me.
Dan, I'd like to talk to you about your May 19th missive, headed up China Wobbles. In that letter, you stated that despite the fact that gold has been a 4,000-year monetary history, it's been money in forever. People have always considered gold to be money, until recent days anyway. You say that there's still confusion regarding its proper price. Can you share with our listeners your thoughts regarding the proper price or the real price of gold?
Sure, but I'd like to first play up on your comment about what money is. I was at a grants conference a few years ago, and he had Bill Ackman as a guest, and he asked Ackman the very question, what is a dollar? He said to Ackman back when Ackman was successful, you're accumulating these things as fast as you are, but what are they worth? What are they? And Ackman responded by saying, well, what I'm doing to protect myself against the dollar is I've just bought the penthouse in that spindly building they put up on 57th Street that Bloomberg, changed the zoning laws to let these billionaires build these huge, ugly towers for $100 million. So he built a $100 million apartment. And that was his hard asset to protect against, the dollar collapsing. I thought about what is he serious in the sense that supposedly he was buying it to flip it to somebody else. You think, who can afford a $100 million apartment? Yeah. Well, that's his price. So more than that. And of course, the answer is a handful of Chinese and Russian oligarchs who themselves depend upon their kind of system to have that kind of purchasing power. And so instead of actually protecting himself from the dollar's demise and the credible demise, he's actually doubling down on his bet. The money he has won out of his hedge fund in the credit battle, in the credit game, he's actually levering up even more so in this purchase. So I do think that understanding what the dollar is and how it functions is important, not just to ordinary people, but the successful people don't understand it either, which I find quite extraordinary. But to answer your question, gold has been money for thousands of years, and I get the question all the time on panels and people talking to me saying, well, what influences its price? Is it interest rates? Is it trade flows? What is it? And the answer is no, you don't get it. Nothing. The price of gold, the value of gold is constant or relatively constant, or at least more constant than anything else that man has ever discovered for monetary use. And that's why gold has been money for all this time. And so the real question is not what changes the price of gold in dollars, or what changes the price of dollars in terms of gold. And once you turn the question around, it becomes a much more clear response. And the answer is another question, which is, what is a dollar? Now, as you probably know, in the original Coinage Act of 1792, the dollar was defined as a certain number of grains of silver, and then various denominations were defined in terms of silver and gold, a bimetallic system, which actually didn't work very well, but at least it was defined as a unit of mass. And now if you ask them what is a dollar, they're a bit flummoxed, and there isn't the answer still. The dollar is currently defined as a unit of liability of the Federal Reserve's balance sheet. That's what a dollar is. And so you say, well, what is its value? Well, there are two ways to consider it. The first is the liability of a balance sheet cannot long remain more valuable than the assets backing it. And so what assets does the Fed have? Well, it used to have, by the way, very short-term government bonds and gold and commercial bills maturing into gold back before the Great Depression. And that made the dollar extremely strong and stable. And now the Fed has as its assets very long-term government bonds, which are very sensitive to interest rates, and then they also own mortgage-backed securities, which are more sensitive to interest rates. So you have these highly, highly volatile assets backing this liability, this thing called a dollar. And so when rates go up, we all know that bonds go down. And so, increasing rates is bad for the dollar, good for gold, just as it was in the 70s. There is a secondary dynamic, however, that's, I think, more short-term effect, but just as real. And that is that if we look at the dollar system as a system, there is about $4 trillion of base money out there, and there's about $90 trillion of debt denominated in dollars. And so when rates go up, everybody who has debt, and that's just about everybody who owns a house or a car or really anything, especially businesses, need to pay more dollars to maintain their debts. And if they don't maintain their debts, they lose their assets. So there's a huge incentive to hold the dollars on hand to make your interest payments on your debt. So when they jack rates up, the demand for dollars as a thing, as its own thing, as the paper itself, goes up, and so the value goes up, and then gold, everything falls. And so you have these two competing effects. The short squeeze aspect of it, I think, is the more immediate, the more powerful in the short term. But the valuation aspect, which is what is the dollar's value as in terms of its assets, is the more long-term and more important relationship. And I think we're nearing the time when the short squeeze on the dollar is going to break, and the value of the dollar is going to sink to the level of the assets backing it. And in an environment of rising rates, that is going to be a very low number indeed.
It really is quite a dilemma for us guys that understand this, what you're talking about, the instability of the system. But timing is everything, Daniel. I keep thinking I'm the laughingstock of a lot of my friends who have enjoyed profits during this last bubble we've had since 2011 or so until last year. Gold and gold shares were a horrible place to be. You'd be much better off in the dollar, in the stock market. And the stock market continues to see new highs, it seems. How do we know when to get off the train? And I mean, certainly you wouldn't be one that would say we need to have everything that we own in gold. We must certainly have to have some other investments from time to time. Do you not agree with that? Yeah,
well, Jay, first of all, say you're a very good company. You may recall that Sir Isaac Newton made some money at the beginning of the South Sea bubble, and then he got out. He knew it was a bubble, and it kept going up, and all his friends were getting richer and richer and richer, and he got annoyed that his less intelligent friends were making such money. So he jumped right in back at the top and lost a huge amount. And so, having your friends laugh at you is not easy. On the other hand, when everyone's involved in a bubble and you're not, I think at the end of the day, you'll win out. And I think especially in the context of now where the credit bubble, at least this round of it, certainly seems to be closer to the peak than the bottom. I think these things they're curves, they're fractals, they're parabolas, they're these mathematical figures that are very hard to figure out where you are on the curve mathematically. And so, it could keep going. And also in a bubble, usually most of the gain is done right at the very end. And so, unless you're extremely fleet of foot to get at the top, it's virtually impossible. But in terms of timing, if you look back at the last century of the Fed's influence and the century before that under the Bank of England's influence, it's pretty clear, the pattern is pretty clear where you have these credit bubbles grow, these global credit bubbles, even in the 19th century, grow up around the world when interest rates were set too low by the central bank. And then the central bank gets spooked for whatever reason in the 19th century because they were losing gold. In the 20th century, it's because the asset markets are going crazy, and they raise rates to contain themselves, to save themselves essentially. And then what happens is, not immediately, but shortly thereafterwards, the credit bubbles across the planet come tumbling down. And that is precisely what happened, by the way, in 1928. It was Q1 of 28 that the Fed got very spooked about the stock market. They started raising rates for a year and a half. As they raised rates, the stock market ignored them and actually started accelerating higher to the upside, the final climax of that bubble. And about Q3 of 29, the economy starts rolling over, commodities start rolling over, the markets are going higher, the Fed keeps raising rates to control the stock market specifically. They raised rates for the final time in September of 1929, and then, of course, we all know it was in late October, a month and a half later, that the markets collapsed more than 40% over a month period. So I see a very good analogy to where we are now, where the Fed's been raising rates. They're doing it self-consciously to rein in asset markets. Asset markets are ignoring them and going up faster and faster and faster. Meanwhile, we see a lot of the economic indicators that they follow rolling over. The pace of new business lending is falling. Commodities are falling again. When you look at many of the metrics, the Fed itself says it follows. They are either falling or at least the growth is slowing, and yet they keep announcing more rate increases because the stock market is ignoring them. And that can continue for a certain period of time. It's already continued for a certain period of time. But I think once you hit that inflection point, the fall is very, very fast and very, very dramatic.
Daniel, in your article, you talked about how gold, is priced in dollars, but more importantly, we should be looking at how gold is priced in commodities. Why so?
Well, when you consider credit bubbles before 1971, it's very clear because prices were done in terms of gold. So what it meant for commodities specifically to go higher in terms of gold, it was very clear if the nominal price went up, the real price was going up. And the reason these prices would go up in these bubble periods is because what a bubble is in its essence is an artificially low interest rate. What it does is it overvalues long-term cash flows. People want to go build long-term lead items like ships and buildings and those sorts of things, and that puts lots of pressure on industrial commodities. So you see a huge increase in commodities, which of course brings on new capacity. People start developing new mines. I saw last week NASA has a satellite going to an asteroid that has 10,000 quadrillion dollars of iron on it. Maybe they can bring that back. Who knows? But you get such sort of craziness. In the 19th century, was going to places like Siberia and Argentina to get commodities because everyone needs them. And then, of course, what happens is that you get all this overbuilding in long-term lead items, the prices fall, these projects can't make their interest payments, so the banks blow up, and then you have all this overcapacity in commodities, and so commodities collapse. And this story should sound very familiar to anyone who follows markets, because it's precisely what's happening today. And the locus of this bubble is China. China absorbs roughly half of all sorts of commodities, copper, tin, iron ore, et cetera, and they buy these things to build ghost cities that have no cash flow. They buy them to build, secondary ring roads around tertiary cities, et cetera. Fast speed rail to nowhere. It's a bit like Pharaoh when he took all the wealth in Egypt to build a pyramid. It looked very impressive, but it doesn't produce anything. And these assets the Chinese are building don't produce anything. And so at some point their bank system is going to blow up. According to Kyle Bass, who follows this stuff very closely, it is already blowing up as these wealth product management products, which are basically borrowing short to lend long, which is all a bank does, are not rolling, and so that usually signals the end of these things. And when that happens, the demand for commodities to build these pyramids is going to collapse, and so the commodity prices will collapse too. And again, gold is relatively, and I say relatively, immune to this because people don't build things with gold. It has no cash flow, and so it's very resistant to the business cycle, and that's precisely what makes it good money. George Gilder wrote, I think he's right about this, it's impossible, the Gödel theorem apparently makes it impossible to measure a system in terms of something within the system. And the point is gold is not within the industrial system because it has extremely little industrial use compared to its supply. So it tells us, it's the signal that tells us where we're in the credit cycle, and what's telling us is that we've gone over the peak. And now the only question is how fast we fall down the other side. Now, the big question is, to me, Jay, is this just one more cycle, and they'll print the money, and then we'll go up again, and so gold bugs will be happy for a few months, and then we'll have some pain again. Well, does that happen, or does the whole system collapse? When the whole system collapses, gold's not going to 2,000 or 3,000; it's going to 8,000 or 9,000 or 10,000, and those numbers are not just picked out of a hat. That is the number required to make gold represent 1/3 of the Fed's liabilities. The Fed says it has 8,300 tons of gold. We know its liability is about $4.5 trillion, and so you just do the math, and the number comes to about 8,000. And that's 1/3 is about the level of backing that this dominant central bank has had for 300 years, the Fed and Bank of England. So that is a real number, not just a pie-in-the-sky number. And that's what will happen when the whole cycle ends, not necessarily this next round, but that's where we're headed eventually.
All right. Well, that presupposes then that the dollar basically ceases to exist, at least in any meaningful way, in terms of its value, I would guess. But also, it seems to me, Dan, what you're arguing for is gold in relative terms, gold relative to commodities and other assets. In other words, copper and iron and prices for basic commodities could go down, and so could gold, I guess. But it's a matter of gold retaining relative value over everything else. Do I have that right?
Well, yeah, down in terms of what? Again, I mean, in the first round of the big credit collapse, gold can go down in nominal terms because there's a big short squeeze on dollars. That's true. Mm-hmm. But we know the Fed's going to print the money to bail it out. Even if they don't, bail it out, what happens is all the bonds the Fed owns starts being defaulted upon. There's no tax revenue. So the plunge in gold, which can happen, doesn't necessarily will happen, but it certainly can happen, is guaranteed to be short-lived. Now, how short, I don't know exactly, but short-lived until either the bank system starts teetering along with the government or until they print. But yes, in the crisis, in the crash, commodities fall dramatically as against gold wherever the nominal price of gold is. And of course, this is very good for gold miners because all a gold mine is really is a spread trade between commodities and gold. Your inputs are industrial commodities and your outputs gold. So it's very good for the economics of gold mining.
On the other hand, if we have rapid inflation, maybe gold mining isn't the best place to be, but you sure want to own some gold, I suppose.
Well, let's distinguish between credit inflation and monetary debasement, right? Mm-hmm. Both send prices higher in nominal terms. They're very different animals. Credit inflation, again, is this banking-driven asset inflation that drives commodity prices higher. That's a terrible environment to be in gold mining, and that's the environment we've been in, essentially. Yeah. And then monetary debasement is very different. That's when the unit of account starts collapsing, and that makes just planning for economic projects very difficult. And that is actually the ideal time for gold mining. That is what was happening in the 70s, and I think that's where we're headed, only more so because the Fed is in much worse shape than it was in the 70s. It doesn't mean that this means hyperinflation. The dollar disappears. I mean, don't think about it. The dollar in the 70s went from being 1/35 of an ounce of gold to at the peak 850. That was a huge decline. Yeah. But the U.S. didn't collapse. We're also here. So I'm not a Weimar Germany guy yet. But yeah, I mean, you can definitely have the unit of account really fall pretty low over a period of time and survive. But the gold investors do very well in that period.
Dan, with just a few minutes left, getting back to China, you talked about the problems that, it would seem almost inevitable that we're going to have some sort of a banking crisis, a collapse of the system, if you will. But China has been building up their gold reserves tremendously. We don't know exactly how much they own, but they are the largest gold producer in the world. They have encouraged their citizens to own gold. We get reports of gold coming through Switzerland into China over the last number of years. By some accounts, Alistair McLeod and others, suggest that China has an awful lot more gold than what they're admitting to, an awful lot, maybe getting closer to what the United States claims to have. Why do you think China is building up its gold reserves so massively? Do you think they sort of understand the dynamics of money that you're talking about, that maybe they understand that maybe gold will provide some solidity to this system or to a recreation of a new system that might have some gold component to it?
Yeah, well, first of all, China's not going to avoid pain. I mean, the problem is they say we're in a regular credit growth and then have a soft landing. The problem is what a credit bubble does is it changes the structure of production of the economy, and so they're going to have a major problem readjusting to reality. Number one. Number two, I do think that Chinese are clever, however, and they understand that the dollar system is limited. It has a limited life, and so if you look back at Chinese history, the thing they care most about, the leadership, is stability. And I think that the idea of importing gold and also encouraging a distribution of gold into the hinterland to make sure that the people have gold is a very wise thing to do from their perspective, because it means when the monetary system collapses, and it will, the people will have some purchasing power. And so it's sort of an insurance to the leadership to try to mitigate the chaos that a collapsing dollar will have on their economy.
All right. With respect to gold, you indicate that you want to own gold mining companies, but not just every kind of gold mining company. Talk to us just with the next minute or so. What kind of gold mining companies are you looking to own these days in this environment?
Yeah, so what I'm very clear on myself is that the bubble is collapsing and the gold commodity ratio is going up. So the margin of gold mining in terms of gold is going to go up, right? One thing that complicates that story is if a gold miner has a lot of nominal debt and the increasing gold commodity ratio happens in a falling price environment, which can happen temporarily, as it did in 2008, that can really put pressure on operating companies that have a lot of debt. And of course, the opposite is also true, right? If gold goes up in terms of commodities in a rising price environment, as in the 70s, that's fantastic for companies with debt because the debt disappears. So when looking at gold mining companies, you have to think about this perspective. I don't mind taking gold mining operating company with a lot of debt if the debt is due in a very long term, because that suggests to me they'll be able to survive a period of falling gold prices, which again, I think is necessarily limited in a crisis situation. Coming with short-term debt, of course, is much more problematic because they might have roll their debt at just the wrong time, and then the equity gets wiped out. Alternatively, when you look at development companies, they're better considered as call options on the story. They don't have debt because there's no operations. They don't have debt. They work on equity, and therefore, again, you care less about the short-term nominal price of gold and more about the medium, long-term gold commodity ratio. So that's how I look at these companies when I evaluate them.
All right. And optimistic about the current environment for gold miners?
I think it's hard to imagine a better environment. Again, I say that with the caveat of that we could have a few month painful period when the really crisis really crunch begins. But I think that'll be shorter than it was in 2008, because everybody's learned, including the authorities, that when this happens, what steps will happen next. I think will happen in much faster order. So it's going to be much harder to catch the swings here. So I don't know that gold falls initially. It may be back in 2008, you had lots of levered hedge funds that were long all these stocks to a huge degree, and gold itself, and they all got margin calls and redemptions and down it went. That's not really as true today. So I'm not convinced it does. I think if it does, it'll be quicker than it was last time. And again, my own view is that when you look at the Fed raising rates in a ridiculously over-levered economy, it's only a matter of time until the wheels start popping up. And it looks like that may already be happening now. So I think it should be fun for gold investors in the near future.
All right. Well, thanks, Dan. We'll have to leave it at that. Thanks very much for being with us.